Bonds explained. Do you even need them? Most Americans are throwing away thousands of dollars by not owning bonds. And I'm about to show you exactly why that matters. Hey, I'm breaking down bonds today because honestly, the personal finance space has done you dirty. Everyone screams invest in stocks, but nobody explains the actual weapon that protects your money when everything hits the fan. Here's the thing. Bonds are boring on purpose. They're not meant to make you rich. They're meant to keep you from going broke. Part 1. What the heck are bonds? Let's use real money. Say you have $5,000 sitting in your checking account doing absolutely nothing. The US government walks up and says, "Hey, can we borrow that for 10 years? In return, we'll pay you 3% every single year." That's a bond. You're a lender. The government is the borrower. You get paid interest for letting them use your money. But here's where it gets interesting. You don't have to lend to the government. You can lend to corporations too. Apple needs cash? They'll issue a bond. That $5,000 gets you paid consistently while Apple uses your money to build new products. The math is straightforward. Buy a bond for $5,000 at 3% interest every year for 10 years. You get $150. Then you get your $5,000 back. Total, $6,500 profit. Compare that to your savings account giving you 0.01%. You'd make $50. That's the difference between real growth and pretending your money is working. Now, there's a catch. That 3% sounds weak compared to the stock market averaging 10% annually over the long term. And you're right, bonds are slower. But slower is the entire point. Part 2. Why you actually need them. Remember March 2020? The stock market dropped 35% in like 4 weeks. People who only owned stocks watched their portfolios get obliterated. Their $400,000 retirement accounts became $260,000 overnight. Meanwhile, people with bonds didn't see that drop. Their bond allocations stayed stable. In fact, bond prices went up because the Fed cut interest rates. So bond investors actually made money while stock investors were getting slaughtered. That's not luck. That's strategy. Here's the real talk. Bonds and stocks move in opposite directions most of the time. When stocks tank, bonds usually rise. When bonds fall, stocks usually rally. It's called negative correlation and it's the most powerful risk management tool available to you. Let me give you actual numbers. Say you're 30 years old with $100,000. You split it 60-40. Stocks and bonds. During 2022, the worst bond year in decades, your portfolio dropped maybe 12%. Someone fully in stocks dropped 25%. That 12% drop on 100,000 is 12,000 lost. The 25% drop is 25,000 lost. That's $13,000 you kept in your pocket by owning bonds. And here's the psychological part nobody talks about. When your portfolio is down 3% instead of 25%, you don't panic sell. Panic selling at market bottoms has destroyed more wealth than actual market crashes. Part 3. Do you actually need them? If you're 22 years old and won't touch your money for 40 years, bonds might not be your best friend. You can tolerate that volatility. Your age is your advantage. You have time to recover from crashes. But most of us aren't actually that person. If you're within 10 years of retirement, bonds aren't optional, they're essential. If you retire at 65 with only stocks and the market crashes 40% at 66, you're in trouble. You're living off that portfolio. You might be forced to sell stocks at the worst time. Bonds create what financial advisors call a sleep at night fund. It's literally money you own. That won't destroy you psychologically. The sweet spot for most Americans? Get bond exposure through low-cost bond index funds. A Vanguard bond fund costs you 0.03% per year to own. A Fidelity bond fund is similarly cheap. You're not paying some advisor 5% to manage this. For someone in their 30s with a solid income and stable job, maybe 30% bonds, 70% stocks. For someone in their 40s, 40-40-20 split between stocks, bonds, and alternatives. For someone 5 years from retirement, 50-50 at minimum. Strong CTA and close. The truth is boring. Bonds are boring. But boring is exactly how regular people build actual wealth without losing sleep. Sexy portfolios make great YouTube thumbnails. They don't make great retirements. If you're just starting to understand personal finance and you want to build something real, hit that subscribe button. New videos every week about the actual strategies that work. Comment below. Are you a stock guy or do you actually own bonds? Let's talk about it. Thanks for watching.